Hello, I'm John Reade, Chief Market Strategist at the World Gold Council. We're the member development organisation of the gold industry, formed over 30 years ago. Our members are a diverse group of major gold mining companies from around the world. As an authority on gold, we work to increase access to and the ownership of gold, primarily amongst investors. We set standards. We help countries develop and improve gold markets. We engage with central banks and sovereign wealth funds, as well as investors in the gold trade. We write research and publish data, all available for free on our website, gold.org, and via our platform, Gold Hub. The topic of this presentation is gold in the age of coronavirus. In most ways, 2020 has been a year to forget. I'm not going to talk about the coronavirus itself, as I'm no expert, but the impact on economies has been dreadful. Output has contracted, unemployment has soared despite government programs that have tried to protect jobs. Budget deficits have spiraled, and the stock of debt of all countries will end up materially higher even under optimistic recovery scenarios. Gold has traded strongly in 2020, hitting a new all-time high of about $2,067 per ounce in early August, before correcting and then consolidating around $1,900 an ounce. I'll talk about the sell-off in response to the great vaccine news later. Note that gold's strength has occurred when the US dollar has been stable or strong over the past 12 months. This has allowed investors and producers that don't use the US dollar to benefit from the rise of gold as well. Investment demand has driven gold higher this year, especially ETF and coin demand from European and North American markets. Demand for smaller investment bars has been less positive, as stronger developed market demand was offset by weak demand from emerging markets. A few countries, such as Thailand, even saw disinvestment due to economic stress and high gold prices. But aside from strong investment demand, other aspects of the gold market have been less positive. The collapse in consumer demand for gold has escaped most people's attention. On a net basis, this component normally makes up about 40% of total demand, roughly equivalent in importance to that of the investment market. In the first 9 months of 2020, jewelry demand slumped by 41% to 904 tons, the lowest in our data series and representing a larger decline than was seen around the global financial crisis. High prices contributed to this fall, but the main factor was the lockdown that affected economies. In the first half of the year, jewelry demand fell in every country that we monitor. There are signs of sequential recovery in most markets, but 2020 will be a weak year for jewelry demand, irrespective of how quickly it improves from here. The other contributor to consumer demand is technology, which normally accounts for about 7% of net demand. Within tech, the largest application is in electronics, notoriously sensitive to the global economic cycle. In light of the plunge in economic activity, it's hardly surprising that tech demand fell by 10% in the first 3 quarters of 2020. Central banks have also bought less gold this year, even turning small net sellers in the third quarter for the first time since 2010. We were already expecting a slower rate of net central bank buying in 2020, as last year saw some large one-off purchases. Also, the Central Bank of Russia, which has been a major buyer for more than a decade, announced it would halt purchases on the 1st of April and has bought no more gold since then. The recent central bank sell-out had some specific reasons, and this isn't, we believe, a sign that central banks have halted their gold purchases. But we do expect less net demand from this category in 2020 and possibly beyond. Supply of gold to the market has also been affected by the coronavirus. Mine supply is down about 5% year to date, mostly due to production interruptions from the pandemic, while recycling supply fell in the first half of the year before recovering a little in the third quarter. The bigger question about potential medium-term declines in gold production, the so-called peak gold argument, remain unanswered, even after the 1% fall in mine supply seen last year. Challenges in unpicking the impact of the coronavirus from underlying mine supply changes over the next few years will leave this question unanswerable for a while. We published a mid-year 2020 update in July, refreshing our views for the rather large changes that have occurred in the gold market and the global economy since we last published on this topic in January. In short, the outlook for gold for the remainder of 2020 and beyond will depend upon the ability of investment demand to offset weak consumer demand. Although we are expecting an improvement in consumer demand in the second half of the year, and there are signs that this is happening already in India and China, 2020 will be a poor year for consumer demand. Similarly, next year will probably see lower consumer demand than normal due to higher prices and still weak economic activity. Central banks will probably buy less gold in 2020 and also next year. Supply will continue to recover over the next few quarters as production interruptions decrease and scrap potentially increases. So for gold to continue to prosper, investment demand will need to compensate for consumer slack, slightly weaker central bank purchases, and probably improving gold supply. We believe four factors will support investment demand for gold in the second half of 2020 and into next year. A combination of high risk, low interest rates, and positive price momentum. The potential for a correction in equity markets is elevated following the strong but narrow gains seen this year, arguably disconnected from economic fundamentals. If such a sell-off materializes, we could see accelerated interest in gold. With bond yields so low, buy and hold to maturity investors are locking in low, even negative returns. And very low yields mean that bonds now offer greatly reduced risk protection to portfolios. In our conversations with gold investors, very low government bond yields have been a major factor driving institutional investment in gold this year. Some investors are also looking at gold because of the prospects for longer-term inflation, perhaps after a nearer-term period of deflation. Before I finish, I'd like to talk about gold's more recent performance. On Monday, November 9th, after a weekend that had appeared to sort out the US election result, gold was trading firmly up above $1,960 per ounce. Then, news hit the wires that some initial results from phase 3 trials of the Pfizer-BioNTech vaccine suggested that it was 90% effective. Over the rest of the trading day, gold fell more than $100 from high to low, as equities, the dollar, and real bond yields all moved higher. At the time of recording, gold has clawed back some of these losses and is trading around $1,870 an ounce. From a personal perspective, I believe this is fantastic news, even with all the caveats about early stage results, needing peer review, awaiting approval, some distribution headaches, etc. But despite this, it does look like the light at the end of the tunnel that we've all been waiting for. But the vaccine won't cure the economy. The damage from the coronavirus pandemic will require further monetary and fiscal action around the world, and the recovery will take time. And there will be long-term consequences from the coronavirus recession as well. Permanent economic damage has been done, and nations' outstanding sovereign debt will be much higher when it's all over. I'd also caution that the fantastic vaccine news could also cause some negative consequences. It will be harder to persuade less effective demographics of the need to social distance. And some politicians may use it to argue for more fiscal spending is unnecessary, and that on top of that, a US government that may be deadlocked for the next few years. We believe that the reasons why investors have added gold to portfolios in 2020 remain as relevant now as they did earlier this year. We continue to advocate that gold should make up a strategic component of all portfolios, even more so after the recent correction. I'd encourage you to stay in touch with the World Gold Council through our research, our website gold.org, and via social media channels. Thank you very much.